The other thing that I would say is always be recruiting. If you don't have an internship program at your individual practice, I would encourage you explore an internship program, reach out to your local universities, bring in young talent. Quite honestly, the talent is good and it's relatively inexpensive. Cycle through interns, have an ongoing annual internship program. Don't just have a one time per summer. And then as you're going through those interns, identify who's going to be the best fit for your organization and then offer them a role and plug them in as you continue to grow.
Hey, everybody, welcome back to another episode of Next Mile. I am your host, Kyle Van Pelt, and today I am joined by Matt Matrisian. It's like magician because that's what he is in this industry. So that's Matt Matrisian. He is the president of Signature Estate Investment Advisors, otherwise known as SEIA to most of you in the industry. And his pride and joy is that he has a blended family of 6 kids. They're like the modern day Brady Bunch. And he is so happy to be able to talk about them, which we're going to today. But Matt, thanks so much for joining the show.
Well, thanks for having me. Love the energy right at the gate.
Yeah, absolutely, man. We got to bring the energy. We got to have fun because there's a lot of energy going on in the industry. And there's a ton of energy going on at your firm that I can't wait to dig into. But before we dig into that, I ask everybody the same first question, Matt. I've had over 100 conversations like this one on air and off air. And what I've found is everybody has their own unique path into this industry that we love so much. Some people, it's a traditional path where they followed in family footsteps. Like maybe their parent or grandparent was in the industry and they're like, oh, that's great. I want to go do that. Some people that I talked to didn't even know this was an industry they could be in. They had a whole separate career and they came in through the side door and stumbled into this and fell in love with it. But what we found is whether your path is traditional or untraditional, everybody has what we call a money moment. And that's a moment in your life where that light bulb clicks and you go, this is it. This is what I want to do. This is what I'm called to do. So for you, what was that money moment that led you to be sitting in the chair you're in today having this conversation with me?
Believe it or not, my money moment took place when I was a sophomore in high school.
Okay.
Yeah. For whatever reason, it clicked for me. And at that time, my dad and I, we would play this game where we would each have a pool of fake money to invest. And he started to teach me about the stock market. And this is back when you would get the newspaper every day and you would look at your individual stocks. Him and I would have this competition and we would allocate funds. I think it was like $50,000 that we would then buy individual stock securities on pencil and paper. And then we would track the performance of them. And ultimately, that's what kind of led me into, at that time, it got me energized. I wanted to be a stockbroker and I continued on that path. Went to my undergraduate, got a degree in finance, a minor in marketing. They got my MBA. At that time, I was living in Florida in St. Petersburg area. And I started at Raymond James Financial on their operations side. And my career took off from there.
Man, that's awesome. What a cool money moment. I know we were talking off camera a little bit about, you said your pride and joy is your blended family. And we found out that we both have twin boys, but now I'm filing this away like, hey, I need to do something like that with my sons because I think that would be a ton of fun. Maybe that will be their money moment.
Oh, it was fantastic. And I will say more often than not, I beat him.
Let's go.
It was fun.
That's awesome. I love that. Okay. So let's dig into SEIA. You were recently named president over there to support this next stage of growth, but they were already a crazy impressive firm. And so you really know how to pick them. You come in here to SEIA, but you are there you guys have a big future ahead of you, right? There's plenty of runway. There's plenty of room to grow. So talk to us about what the previous stage looked like for SEIA that got them to this level of success, but now also what that next stage looks like. What's the future vision for where you're going?
Yeah, I'll give you a little bit of background, kind of set the stage. So SEIA was really founded by 4 partners that kind of came together. And their roots and heritage was kind of on the insurance side. And so they started off John Hancock doing insurance business and then ultimately migrated over to the wealth business. And based off of that, they found that they were able to connect with clients very easily, to be able to gather new assets, new clients, and they built up their individual, I'll call books of businesses and client base. Coming together as 4 partners, as they continue to grow, they started to bring on G2, G3 to be able to come in and backfill to be able to support their growth going forward. Fast forward, they grew to effectively as individual kind of practices, multi-billion-dollar kind of practices that kind of formed this entity, this firm. And then they decided they had other advisors that kind of gravitated to them based on their growth trajectory. They were using Schwab and Fidelity as kind of their major custodians, formed their own RIA and SEIA, and then ultimately broke away underneath the umbrella. And then from there, more and more advisors started to gravitate to the firm. We also started an in-house outsourced platform for independent advisors to be able to plug into our investment management capabilities. So SEIA really is kind of, I'll say, 4 different kind of companies rolled up into one. One, we have our kind of wealth management business. We also have SIA, which is our in-house TAMP offering, which we support 350 or so individual advisors and allow them to outsource their investment management. And then we have our limited broker dealer and then also our insurance agency. So as an individual advisor, you can do pretty much anything under our umbrella. Now, keeping in mind that those 4 partners came into the firm as independent contractors. So all the advisors, if you take even back to last year, last 18 months, all the independent advisors were 1099 independent practitioners. And now in 2022, we get acquired by Reverence Capital Partners, private equity firm, wants to be able to continue to grow the firm, grow EBITDA, and give us capital for expansion. And so that kind of led to us starting to look at external acquisitions, also talking to our existing advisors, our 1099 advisors, and transitioning them from being independent to effectively being equity owners in the firm. And so you had this firm that was built from ground up by advisors. And now we're basically bringing all of those advisors together to be able to say, look, if you want to be able to have an equity stake in the firm, if you want to be able to participate in the growth of not only your own practice, but the growth of the organization, we now have a platform to be able to do that. And over the last year or so, we started to systematically approach our advisors to be able to effectively transition from 1099 to W-2 to be part of our growth trajectory. And we're super excited about that. I'm happy to go into more detail there, but you start to think about the future growth of the firm. It's really doubling down on that transition, looking at inorganic growth externally and finding advisors that really want to participate in our culture and participate in the growth trajectory. Historically, we're growing at 10+%, double-digit growth year over year, organic growth as a firm. And that's really what historically has brought advisors to the organization. They say, look, I want to be able to continue to grow. You've got infrastructure, you've got the teams in place, you've got the support capabilities to enable that growth, and they want to be able to be plugged in. So I'm super excited about our future.
There's so much to try and double click into that. So hopefully we have time to get to all of it. I took some notes here to try and make sure I don't forget. Okay, the first one, I just want to nerd out with you for a second. So I've talked to a lot of people about this concept of, okay, how do we transition from a bunch of 1099 advisors or contractors that sort of platform with us or whatever into, hey, we're all sharing in a larger enterprise value, right? So you guys take some equity in the new thing and we're all going to grow this new thing or whatever. But I always hear people say, hey, we had to set up a new platform for that to be able to transition it. Can you just highlight for me, okay, what does the new platform have to be able to make this transition successfully without a huge disruption to the operation? Because you guys keep growing, everything's going well while we're in the midst of transitioning people.
For us, I would say it was a bit easier than most because the advisors that would affiliate with SEIA, even though they were independents, they were effectively adopting our brand. They were adopting our ADB. So they're coming in as IARs. They were adopting our technology stack. They were leveraging the same custodians that we would use. And operationally and from an infrastructure perspective, it was a relatively easy transition for them to go to 1099 to a W-2 model. In addition to that, what we would do is for that 1099 advisor, we may have their staff effectively acting as W-2 staff within our ecosystem. And then we would effectively charge back the 1099 advisor for that expense, which allows us to provide things like health insurance in a scaled way, offering support, technology, and everything else. So they're not having to go out on their own and basically build that or recreate that. So that transition largely for the advisors internally within our ecosystem, it's close to seamless.
Sure.
So effectively what we're doing is we're going out and talking to them about how do you think about the differences in payout structure? How do you think about going from doing things like covering your own rent, covering your own expenses as an organization, T&E, travel, all of those things, and bringing them into a W-2 model where we're effectively going to cover that. So if you're expanding and you need to hire more staff, you're not having to go out and source that individual on your own and do all of the hiring and doing the comp model and everything else. We're going to do that for you. If you're having to negotiate your rent from year over year, we're going to do that for you. So if you're having to negotiate your technology contracts, that's on us. So we're taking that business complexity off of their plate in a lot of cases. And so effectively what we do is we reach out and say, look, let's look at the numbers. Let's look at what you're netting today as an individual advisor and what your payout structure is. Let's look at what that looks like under a W-2 model, understanding that we're absorbing all of your expenses. And effectively, we're putting together a package where they can have equity in the firm. They can participate in EBITDA expansion, even a multiple arbitrage. They can obviously get incentives for continuing to grow their own practice within our ecosystem, so on and so forth. So for the advisors that find that to be attractive, they lean in. I would say that I envision SEIA as always being a dual affiliation model. We will always have W-2 and 1099 advisors. What we want to be able to do is give the best of both worlds to advisors and how they want to affiliate with us.
Yeah, I love that. I think I've had some other conversations, and it's really interesting to see how the industry's pendulum swings, right? Because for a while it was like, go get the highest payout you can, right? These people are paying, 93% payout, but then you've got all of your own expenses and whatever. And it's like some people started going, wait, what's the net payout, right? So you're getting a 93% gross payout, but then you got to pay for your office and your supplies and your staff and your tech and your this and all of a sudden, and then you look and your net payout's 42% versus if you're getting a 65% payout, doesn't look as good as 90%, but hey, if that's all in, turns out that's actually better for you in a lot of ways. And I think people started looking at that equation again, and now they're coming around going, oh, wait a second, hold on, maybe this is a better model.
You are absolutely spot on. In fact, in addition to that, I would say that the life cycle of the advisor has almost come full circle. So if you think about a lot of our industry advisors started off in the wirehouses, and then they said, you know what, this kind of shift to independence is interesting, and the ability to be an entrepreneur, run my own business, get a higher payout. And you saw a lot of advisors shift to go independent, tucking in under an independent broker dealer. And then eventually a lot of them started to form their own RIA, maybe be a hybrid for a period of time. Then they dropped their broker dealer registration. Now they're operating as a fee only firm. Fast forward, now you're seeing consolidation in the industry and advisors saying, okay, you know what? I'm at the stage of my career, being an entrepreneur, running on my own business, all the complexity that goes into that. It's a lot, right? And I got in this business to work with clients and be an advisor. And maybe there's an attractiveness beyond just the numbers and the economics, but maybe there's attractiveness at the stage of career that I'm at to be able to reduce the complexity in my life, to be able to engage with clients the way that I want to be able to engage with them, and then shift that complexity to a scaled organization that can take that work off of their plate, allow them to be an advisor and kind of shift back into a W-2 model. We're finding a lot of advisors that's very appealing for, especially those advisors that have seen a significant appreciation in their business and they don't have a G2 that can actually afford to buy them out. It's been very interesting kind of shift.
Yeah. Oh man, it's almost like the unbundling and the bundling and the unbundling. Those trends happen in every industry, right? And,
yeah, that's exactly right.
Very fascinating. All right. You also talked about how one of the business lines that you guys have is SIA, Signature Investment
Advisors.
Okay.
Advisors,
So which is an outsourced investment arm that they can work with. Is it safe to say that's an internal TAMP? Is that a fair statement?
Yeah, to a large degree. We have obviously an in-house investment team that we work with our wealth management advisors. I would say in addition to that, SIA also has distribution to advisors outside of our wealth offering.
Oh, cool.
So think about an independent advisor that's sitting at Osaic or LPL or another independent broker dealer. they can effectively access our investment solutions directly and to be able to plug in and, again, at least reduce the investment complexity and outsource that capability to us to be able to handle on their behalf. And so we will work hand in glove with that advisor to be able to customize individual portfolios on behalf of clients, allow them to free up their time so they can go out and prospect and build their business.
Yeah, that's great. And the reason I wanted to ask you about that is I feel like there's another trend brewing a little bit, which is firms get to a certain size and they go, we should start to offer services that look like what you just described, whether you want to call it a full TAMP, but hey, we'll centralize trading. We'll build models or portfolios for you, right? We'll do a lot of this work and then you can work with us on this. And it's a part of our platform that we give to you. I think my question I want to ask, especially with your background and for those who aren't familiar. So Matt was also an executive at AssetMark, one of the most successful TAMPs in the industry, and has had a great run and continues to have one. And they're not going anywhere by any stretch, but it just seems like firms get north of a couple billion, maybe a little bit more than that. And they start going, we should start doing this. And so my question to you is, should larger firms become their own TAMPs or asset management arms, or however you want to think about it, like true or false? At a certain point, they should absolutely start to offer this service to their advisors.
Yeah, that's a fantastic question. My answer would be true. And I think that at least to be able to give the optionality. Now, you have to think about the infrastructure and what it takes to be able to do that. I don't think that's necessarily at a couple $1 billion in total assets. I think you have to be north of 5 to 10 to really be able to do it right and to be able to scale it across your organization. And I want to be absolutely clear. We don't require advisors to use our TAMP.
Yeah.
So it's an option for them. In fact, a significant amount of our total wealth assets are actually being managed by the individual advisor themselves. So it's an option for them. We want to be able to allow our advisors flexibility and autonomy in the way that they engage with their advisors and to be able to deliver investment advice. And I do think, though, that advisors that, again, want to reduce complexity, want to be able to scale their business, to be able to have that option available to them, I think is super important, but not a requirement by any means. I do see other firms, especially other acquirers, for whatever reason, could be economics, could be compliance oversight, could be just scale and consistency of story, where as part of their acquisition model, they're ultimately telling that advisor, look, you need to stop managing your own portfolios and you need to adopt our investment management capabilities as part of this transition. That's not something that we do. It's basically an option for you. If you want to, that's great. If you don't, that's fantastic as well.
Yeah, I love that. I mean, to me, that inherently makes sense. You get to a certain size, especially if the story you're telling to advisors is, hey, we're just trying to create the best support platform for you possible. So Absolutely. You can run off of our compliance, you can run off of our ops, but okay, great. We're going to give you an investment management option as well. And at Milemarker, our business is about aggregating and consolidating all of the data from this stuff into one place. And one of the big things that we see is at firms like yours, hey, we have a bunch of great investment options available. Like, how do we create a cohesive experience around that? So we run our own models. We work with outside partners. We let you do rep as PM. We've got alternative investment platforms like Case or iCapital or something like that. We have all these things that are great, but now, okay, we've got 7-8 logins for investments. How do we consolidate that into one beautiful advisor experience for you to be able to look at everything that SEIA has to offer? So that a firm like you can fulfill exactly what you just said. Hey, do whatever you want. We just want to make it easy for you because that's the promise that we're giving to you as an advisor.
Yeah, that's exactly right. And to be able to provide that flexibility and eliminate the swivel chair experience of advisors having to go across multiple different platforms, to me, that's where firms, especially the size of SEIA and our peer group, that's where we need to be spending our time, to give them that kind of technology platform that integrates everything, that be able to consolidate into a data lake solution and to be able to surface their assets, regardless of the platform that are being used, or the investment vehicle that's being used, in an easy way for advisors to be able to digest and monitor. Absolutely.
Yeah, that's awesome, man. Okay. And then the last thing I wanted to double click on from that initial answer, and then we can start talking about some of the other things. 10% organic growth is pretty great considering the industry average is 2%. And then actually, if you remove like the top 10% of the industry, the organic growth, it's actually negative, right? So the fact that you guys are growing 10% is pretty impressive. I think, again, your former shop is incredible at the way they grow too. You guys have a growth mindset here as well. it's a twofold question, but how much correlation is there between organic growth and kind of getting rid of all of these other things, like outsourcing a lot of this other stuff to a partner like an SEIA, so you can just focus on spending time with the clients, doing all of that type of stuff? Like, maybe put more simply, it just seems that the advisors that outsource tend to grow more than the advisors that try to manage everything.
There's a direct correlation. There's no doubt about it. In fact, give my prior firm a bit of a plug here. We did on a regular basis an impact of outsourcing study, and it would demonstrate that those advisors that were outsourcing middle, back office, investment management services and capabilities were effectively growing significantly faster than those that were insourcing it. And I can't recall the direct percentage points, but I think it was on average about 6% higher on a CAGR perspective. For us, it's about being able to take all of those capabilities, all of those services, to be able to take that work off of their plate, but then also enable advisors to be able to get in front of more prospects. So we at SEIA are in the fortunate position to be part of both Schwab and Fidelity's custodial referral programs. So we get an enormous amount of opportunity there to be able to support our advisors' growth. In addition, we started running national seminars for advisors to be able to get in front of high net worth and ultra high net worth clients to be able to, again, drive more prospects into their lead funnel and help them convert. We established earlier this year an advanced planning team to be able to allow our advisors to be able to go out market $10 million and up types of clients. And so that's all kind of combined together to be able to contribute to that 10+% in organic growth that we hit year over year.
Yeah, that's awesome, man. Awesome. Yeah, congrats to you on that. I think that's really impressive. And it does just inherently make sense to me that if you can get rid of some of this other stuff, you can focus on serving more families. Because I also think that growth just means you get to serve more families. I think sometimes people equate it to, oh, it's just being salesy, it's being this, it's being that. But if you just look at the demographic trends in the industry, the amount of people searching for financial advice or need for financial advice or whatever, it's up and to the right like crazy. There is just high demand for the services here. And we need to get the middle office and back office stuff off of advisors' plates so that we can serve more families and households that need financial advice.
Yeah, no doubt. The other thing that it's really important to consider in that equation is, okay, let's say I outsource everything and I'm able to free up, I think the studies that I've seen, effectively 8 to 12 hours a week that you can save by outsourcing. So you're free up a whole day. What are you going to do with that time? You have a lot of advisors in our industry and totally comfortable that are lifestyle advisors. And maybe they're at a stage of the career where, you know what, if I had an extra 8 hours, I had a free Friday, I would just take that Friday off, spend it with my family, doing something I love, whatever. Totally comfortable with that. You have other advisors that said, look, if I had an extra 8 hours, I'm going to spend that time building my business and prospecting. And that's where you see effectively that growth differential. If I had 20% more time to go out and engage with new clients, I'm going to see a significant increase in the amount of assets that I'm able to gather as a result.
That's awesome.
This podcast is brought to you by Turncast. We make game-changing content for fintech and financial services companies. Learn more at turncast.com.
Hey, Next Mile listeners, Jessica here from Milemarker. You know, we talk a lot about reaching that next mile in your business journey, but let's be for real for just a sec. If you're an advisor, how much time are you spending wrestling with data instead of actually advising your clients? I've worked firsthand with tons of advisors over the years, helping them achieve real success and breakthrough growth. But I keep seeing the same roadblock everywhere. Brilliant advisors stuck spending hours pulling reports from their different systems, trying to create meaningful client presentations and struggling to get a clear picture of their firm's growth. Does this sound familiar? Here's what I've learned. The advisors who are scaling and growing aren't necessarily smarter. They've just figured out how to get control over their data. That's exactly why I joined Milemarker, because they've built a solution that changes everything for how you manage and grow your firm. At Milemarker, We specialize in 3 game-changing areas for firms like yours: streamlining your data management so all your systems talk to each other, automating those repetitive reporting tasks that eat up your valuable time, and creating seamless advisor and client experiences that actually help you grow your firm. The difference is night and day. Instead of spending your evenings pulling together client reports, imagine having that data automatically organized and presented exactly how you need it. Instead of guessing about your firm's performance, imagine having real-time insights that help you make strategic decisions. If you are ready to stop being held back by your data and start using it to fuel your growth, I'd love to have a conversation with you. We're offering Next Mile listeners a complimentary consultation to explore exactly how we can help you transform your advisory practice. Don't let outdated processes keep you from reaching that next mile in your firm's growth. Visit milemarker.co and mention the Next Mile podcast, and I'll personally make sure to get the insights you need to take control of your data and scale your practice. Because your time should be spent building your business, not buried in spreadsheets.
I want to ask another question about this because I think philosophically this all makes sense to me.
Yep.
But then when you think about how we make sure that we're taking care of the household's overall fees as they look at all of this, right? So if I outsource everything, doesn't it get too expensive for my clients where they're having to pay for all of this other stuff? Or is there a way to, as the advisor, to outsource successfully without me having to make a lot less money, right? But like everybody kind of wins in this scenario. So what would your response to that be?
For me, it's quite honestly, what's the value proposition of that advisor, right? So the whole saying is absent of value, people are going to default to price. And so what's the value proposition of that advisor? And if you look at that advisor sitting at, on average, I think the average fee in our industry is about 90 basis points. If you look at high net worth to mass market clients, call it 90 basis points. If you're adding an additional 20, 30 basis points for outsourcing investment management, include your custody cost, your everything else kind of roll platform cost, you're sitting at, call it 120. Can you deliver enough value from a tax planning perspective, estate planning perspective, holistic financial planning, to be able to engage with that client in a way that they absolutely see the value that you're able to deliver? You can look at just individual tax strategies and to be able to drive tax alpha to an individual client. I've seen studies that say I can drive 200 basis points in annual tax alpha to an individual client if I'm aggressively managing that particular client's taxes on an annual basis. So for me, it goes back to what's the value proposition that an advisor is delivering. And I think if they're able to articulate that in a meaningful way where the clients can get comfortable with that, I think that 30 basis point differential kind of is a non-conversation.
Yeah. Well stated, man. Stated. All right. Let's talk about the future of the industry. Let's talk about how firms should be thinking about G2 and G3. I know this is something that you really care about. So how should firms be thinking about G2 and G3, and especially with the future of advice and all of that type of stuff? Like, how are you positioning that? How are you talking to your advisors about that? And how are you making sure that everybody is set up for the future as you guys continue to grow?
Yeah, honestly, I think one of the biggest things in our industry right now is the race for talent. To be able to identify G2 and G3 advisors that are hungry, they're willing to get engaged, dig in, are focused on growing their individual businesses, delivering value to end clients, and doing it the right way. For us, we are always hiring. If you go to our website, we always have career opportunities across the United States that we're trying to fill places within our organization. I think for most firms, it's really important to be able to have a career ladder, career trajectory that they have in place to be able to bring in young talent, be able to give them exposure to the industry, exposure to the firm, and then to put them on whatever path they feel comfortable. I know at SEIA, we have what we call a client service advisor, a CSA. So we bring them into that role. They kind of understand the operational backbone of the individual, supporting the individual advisor and firm. How do I process paperwork? How do I get new accounts open? How do I do distribution? All of that stuff. And then from there, they can progress and get licensed to be able to become an associate advisor. And then they go up the career path and ultimately be able to be a partner. That's one path. Another path could be you come in as part of our proposal team or part of our investment team. And that's another path. Again, you could still lead into being an advisor if that's ultimately where you want to go, but you're getting a different flavor. If you're coming into our investment team, maybe you're coming in as an analyst and you're getting a real feel for how to construct portfolios in a meaningful way, drive asset allocation, drive alpha where appropriate. And then you can then continue to get licensed and then become a financial advisor and plug into one of our advisors team. We are in the fortunate position because we are growing rapidly that we can effectively push down clients, mass affluent clients, mass market clients to new advisors coming in, give them a kind of a sample advisor base or client base to be able to then support them that they can then cultivate, continue to grow that as well. I think it's being deliberate about what your strategy is, being able to identify what the career progression is for that individual, have a career ladder in place, and put certain kind of markers in place for them to achieve and benchmarks to achieve to be able to grow into that role. And the other thing that I would say is always be recruiting. If you don't have an internship program at your individual practice, I would encourage you, explore an internship program, reach out to your local universities, bring in young talent. Quite honestly, the talent is good and it's relatively inexpensive. Cycle through interns, have an ongoing annual internship program. Don't just have a one-time per summer. And then as you're going through those interns, identify who's going to be the best fit for your organization and then offer them a role and plug them in as you continue to grow. Last thing I'll say about it is don't delay hiring. I find a lot of firms wait until they are way underwater from a capacity perspective, and then they go out and hire their next person. Hire in advance of the need, and you'll be much better off.
That's so good. I love it. I love it. All right. I run a technology company. I'd be remiss if I didn't ask you about technology a little bit as you're growing the firm. So everybody has tech, right? I think every firm in the industry has a tech stack. And then the Michael Kitces tech map is just exploding upon exploding. It seems like it's going exponential at this point. You sitting in the chair you're in right now, I don't think anybody in your seat says, technology is not important. Forget it. Just do the yellow legal pad and build the relationships and it's fine. Everybody's trying to invest. But when you look at all of the options that are out there, it can almost be overwhelming. So how are you strategically thinking about where to put the investment in tech so that you get the most bang for your buck?
It's a great question. And for us, it's two areas. And one area I would say is thinking about, and we touched on it a little bit earlier, is what is that advisor's interaction day-to-day technology stack they're plugging into and trying to remove or reduce the swivel chair as much as possible. What we're trying to do is deliver as much value to that advisor's desktop where they can look at things like share of wallet opportunities by leveraging AI capabilities that are in the marketplace. They can interact with their clients in a scalable way. They can send out mass communications to clients and stay in front of clients and set them up on a kind of drip or a cultivating campaign. Give them intelligence very immediately. So one of the things that is on my to-do list, if you will, is thinking about implementing AI note takers across our organization. Some of our advisors are using that today, but we want to be able to implement that across our organization and make sure that's available. The other thing is that I want to be able to have a centralized data lake for our entire firm. We have one today, but I think it needs to be optimized and have a data lake where an advisor then can have an AI overlay on that data lake. And as they are meeting with clients or have client needs, they can go directly in, use an LLM, a large language model, and be able to say, tell me what's happened in my client's portfolio since I last met with them. And boom, a script pops up and says, here are the key things that's happened in their client accounts. Here's what happened in their portfolios. Here's what their current measure of success is in their financial plan. Here's how macro markets, micro markets have impacted their underlying investments, and basically give them immediate data and information to be able to engage with that client in a thoughtful way. So streamlining their engagement process is super important. And for me, technology, I'm a kind of an AI geek. Some of the podcasts that I listen to are all around AI. And I want us to be well positioned for whatever the future comes as it relates to AI. And right now, I think there's a lot of work for us to be able to get in a position where I feel comfortable that we are well positioned to be able to take advantage of some of the new technology and advancements that are coming down the pipeline.
Yeah, great answer. So aside from maybe a centralized data lake, like you're talking about with AI overlay, I think this would be really helpful because I've actually had lots of conversations about AI in the industry. And it seems like this interesting bubbling of, hey, we're all paying attention. Yeah, there's the note takers. Yeah, there's like the content producing things. But like everybody seems like they're trying to figure out how to position themselves for AI. So for you, besides getting all of your data into one place, which obviously we think is critically important, what are some other things you're trying to do to position yourselves to take advantage of AI for your firm?
Yeah, I'll give an example, and I'll tell you this is on kind of the wish list or roadmap. I would love to be able to have a system that automatically continues to look at our existing client base and to be able to use a system like a Wealthbeat or like a Catchlight to be able to identify, okay, here are within your entire book of business, here are the highest share of wallet opportunities that exist within your book of business. And then here are key components that you need to be able to talk to your clients about in order to be able to leverage those share of wallet opportunities, be able to tee that up front and center for advisors. And I think that would be super important. The other thing is to be able to look at just trends across our firm, understand where we're seeing flows, where we're seeing potential challenges within our organization. I think that's important. And then the other thing that I would say is just from a pure prospecting perspective, to be able to take a client statement. I know firms are doing this today, but be able to take a client statement, to be able to read it, be able to pull the investments down from that statement and then offer immediately an alternative to what the client is how the client is currently allocated, and talk about specific talking points for that advisor to be able to engage with that client in a meaningful way. Right now, that's being done as a point solution and not being done as a scaled solution. And so we have to be much better as a firm to be able to look at how do we scale some of those things. And the only way in my mind to be able to do that is to be able to establish a center source of truth, and that is the data lake. And then from there, we can start to build on additional capabilities down the road.
Awesome, man. Well said. All right. We're already talking about this a little bit. I like to ask all of my guests to get out their crystal ball, look a couple years into the future and tell me what they see coming. And this doesn't have to just be tech. I know we're talking about AI. Obviously, that's going to have massive impacts, but it can be outside of tech as well. Consolidation, in-person seminars, like is that coming back with the rise of all the AI stuff, et cetera? But Matt, in the seat you're sitting in, I know you have to peek around the corner. You have to think about what's coming down the road. So what are some of those things when you look into the crystal ball that you would predict are going to happen in the industry in the next couple of years?
Yeah, that's a great question. I think that for me, we'll definitely continue to see consolidation. I don't think that is slowing down anytime soon. I think that as an industry, we probably have another 5 to 10 years of runway that will continue to see active consolidation take place. I do think that advisors are going to need to figure out how they continue to scale their offering. So the earlier points about delivering value and looking at their own fee model, I think within the industry, and we've seen this already, we haven't seen fee compression at the advisory fee yet as much. Fees have stayed pretty stable, but we have continued to see margin compression, right? So my top line fee staying about 190 basis points plus or minus, depending on the size of client you're working with. But that client is now asking for more. They're asking to do holistic financial planning. I need you to do my estate plan. Can you do my taxes for me? Can you do all of these other things that effectively add expense for that individual advisor? And so their margins are going to be being compressed. I think that we will see a large convergence. We're already starting to see it across our industry, where firms are going to have to be more and more holistic in order to be able to compete. And if they're not holistic, they're going to have to be able to price their offering. If it's solely investment management, just solely financial planning, they're going to have to price their offering much more competitively than what they're doing today. Otherwise, they're going to get into this value versus cost discussion with their clients. To me, that's going to be probably the biggest point that advisors need to wrap their heads around and think about. And that's honestly where I see the consolidators driving the most investment in their firms. We're starting to see consolidators going out and acquiring trust companies or starting trust departments internally. We're starting to see consolidators going out and acquiring CPA firms and bringing in-house CPA capabilities so they can do tax preparation and tax planning in-house. Those types of things, I think, will be the norm for a lot of firms. And if you can't be holistic in the way that you engage with your clients, I think that you're going to be at a detriment. I know that for SEIA, we're making those investments. I mean, we have been for a while, but we're double downing on those investments and making sure that we're expanding the capabilities that we have to offer. So if I look at my crystal ball, is to be able to be much more holistic in everything that you do and be a full service advisory firm. Historically, we've seen the wirehouse be that full service firm for a lot of end investors. And now that the RIAs are continuing to evolve, I think that we'll see RIAs effectively take that full service approach as well.
Awesome. All right. That means we're going to move into the final segment of the show. This is what we call the Milemarker Minute. It's a series of lightning round questions aimed at some fun, lighthearted stuff to get to know Matt the Matrisian outside of your role at SEIA. So you ready for the Milemarker Minute?
Yeah, let's do it.
Okay, awesome. First question. If you could travel anywhere in the world you've never been to before, where would you go?
So I've got two. Okay, so two come to mind. The Maldives is probably my primary one.
One of those huts over the water?
Yeah, exactly. I would love to go to the Maldives. That's on my bucket list. The other one, I would love to do an African safari and do effectively a jungle safari. I'd love to go see the silverback gorillas in real life and just sit there and appreciate the beauty that they bring to the table. So those would be my two places I would go.
I love it. What is the best road trip you've ever been on?
Oh my goodness. To be honest, I haven't taken a lot of road trips, but I would say the best one that I've gone on is in Costa Rica. We went from one side of the country to the other. That was pretty cool to be able to go see volcanoes, be able to go to the beaches, be able to go zip lining, navigate the mountains and everything else that Costa Rica was able to provide. That was a pretty special trip. That was pretty cool.
I love it. All right, finish this sentence. Progress is
growth.
I love it. What is the best flavor of ice cream?
I'm a cookie dough guy, and you're speaking to a ice cream connoisseur. My wife jokes with me, I literally have a bowl of ice cream every night. I love my ice cream. So right now I'm a cookie guy, but I usually shift maybe every 3 or 4 months.
Yeah, I'm speaking to somebody who seems to have their priorities figured out. I think that's great.
Exactly.
So if you're a connoisseur, for all of those listening right now, what's the best cookie dough ice cream out there?
I'm a Ben & Jerry's guy, so I love Ben & Jerry's. There's a cookie dough, American Dream, peanut butter cup is fantastic because they have the big chunks of peanut butter cup in them. So I would highly encourage you to do the Ben & Jerry's.
All right, mountains or the beach?
Beach.
All right. What's the best book you've read or listened to in the last 12 months?
I tend to go back to a book fairly consistently. It's called Execution. And it's really about how do you get things done as an organization. And so I oftentimes reread that.
I love it. All right. Final question for you. There's an alternate universe. And in this alternate universe, Matt has a different career. It's completely unassociated with financial services. In that alternate universe, what is your career?
I don't know. I'd probably be a football player, probably an athlete if I could. I think that would be very cool. And if I had the talent, I've always wanted to be a singer too, but I have a terrible voice. I can't carry a tune worth a lick. But you mentioned earlier, we've got 6 kids. 2 of our kids are highly talented musicians, and I am so envious of their talent.
That's amazing. See, this is why I love the Milemarker Minute, because I bet there's not a single podcast out there that's heard Matt talk about his musical capabilities or talent, but I'm glad we were able to talk about it here today, man.
Yeah, no doubt.
And actually, more importantly, not just your musical talent, but your kids and how great they are. That's really cool. And I'm glad we got to do it. So that wraps up the conversation, man. Thanks so much for dropping insights on how you're building the firm, the way you're thinking about the firm, AI. This was jam-packed with a lot of great information. And I'm so thankful you carved out the time to come and have the conversation today.
Yeah, Kyle, thank you so much. I appreciate the invite. I appreciate you having me and hosting. This was an awesome time well spent. And I hope to be able to do it again sometime in the future. This is fantastic.
Absolutely. We'll have to have you back on. Okay, everybody, that has been another episode of Next Mile. Please make sure you click follow or subscribe wherever you're watching to this or listening to it. And if you'd be kind enough, leave us a review, 5 stars preferably if it was good, so that people who've never heard of the show before can find great conversations like this one I just had with Matt. But until the next episode, enjoy every mile.